First of all, where they were in June policy and right now, there has been a marked change in the communication. They sounded actually very hawkish. After a 50 basis of rate cut in June policy, we actually seen bond market yields to go up. But when I've looked at the October policy, the reasons for them marking down the inflation and growth projections have been twofold.
Okay, so that was my next question to you. How should investors look at investing across the entire curve? Hello everyone. Welcome to Moneynomics by Axis Mutual Fund. I'm Shalini Gautam and I have with me Head of Fixed Income Devang Shah. Today we will discuss the latest monetary policy action by the central bank, the future of interest rates in India and in the US, and the outlook for investors. So Devang, let's begin. In this October's monetary policy, the RBI left interest rates on hold but indicated a dovish stance. What do you think? How should investors read this policy?
So first of all, yes, you're completely right. The monetary policy, all the rates were status quo. There was no change in monetary policy rates, except for 2 dissents from independent members. I think as widely expected by capital markets, RBI kept all the rates on hold. But the most important perspective will ask me, I think this policy is the way things have been communicated about future guidance, how they have marked down the growth and inflation projections, and that is what has given some more clarity to bond markets and fixed income markets specifically about how the way forward would be. So I think the policy communication was significantly dovish, and there was a clear communication that with the growth inflation dynamics, the way they are currently, it opens up some space for monetary easing. Another important point which I try to dwell upon is that how they've looked at the growth inflation projection and why the changes have happened in the growth and inflation dynamics. First of all, where they were in June policy and right now, there has been a marked change in the communication. They sounded actually very hawkish. After a 50 basis of rate cut in June policy, we actually seen bond market yields to go up. But when I've looked at the October policy, the reasons for them marking down the inflation and growth projections have been twofold. The inflation projections come down because of the GST cuts. The GST cuts give them some leeway. I think that there is a 40-50 basis reduction in projections for inflation the next year. Secondly, it is all about the growth cycle. Now they've got more and more clarity about the tariff rate which is going to get implemented for India. With the 50% rate, we are one of the outliers as of now. I think obviously sooner or later the additional tariff rate will get reversed. But currently with the 50% tariff rate, every day where it is going on, the impact of growth is significantly started to increase. And that is what has led to a markdown in growth projections for them in H2 as well as next year. So lowering growth projections as well as lower CPI projections has opened up some space, and that is what RBI has communicated very clearly in this monetary policy. How much is the space opened up? As per us, I think there is a clear 25 to 50 basis opportunity and for the policymakers to cut rates. 25 basis rate cut might get delivered in December policy. If for some reasons the tariff uncertainty continues, I think there is a very high probability that they might go up with another 25 basis rate cut in February policy. So in total, 50 basis of rate cut can get delivered in bond markets.
Okay. So this is what you said about India. This is the future projection for the our policy. But how do you read the US? The Fed has lowered its interest rates by 25 bips. How many interest rates cuts do you see there? And where do you think is the economy headed? Because it does seem the economy is going pretty strong.
Right. See, I think Fed has themselves guided for another 1 to 2 rate cuts in this year and probably 2 rate cuts next year. So they're talking about now totaling with the rate cut which happened last month, totaling to around 4 additional rate cuts. As per us, I think 3 or more rate cuts might get delivered. See, from an economy perspective, there is a mixed signals, and US economy is actually giving up mixed signals on both fronts. You look at the unemployment data, and somewhere down the line you look at how the employment data has been panning out, there's been continuous downward revisions. That gives fear to Fed that somewhere down the line, if employment has started to increase, it might lead to slower growth in the future. But when I look at the high frequency indicators and we look across at the overall macro data, the macro data is not weakened much. So I would say in a situation where macroeconomic data in US is a mixed bag, unemployment big slower, but the other data still stacking up, inflation not significantly inching up because of tariff, I believe so 3 to 4 rate cuts are possible. But I would say that significantly below 3.5, the Fed fund rate to go significantly below 3.5, it will take some time. So our best case assessment at this point of time is that the Fed fund rate will hover between 3/4, 3.5. And for US Treasuries, they have already seen some rally. The US Treasury is now closer to 4%. We might see it once going down to around 375. Impact of that on our bond markets, I think, will be limited because our bond markets will look at all the local cues. At this point of time, there are some demand supply imbalances which are going on, and that is why we believe that from here on, from policy day, we have actually seen around 10-15 basis of rally. From the time when we spoke last, if you recollect, we had said that tactical opportunities are getting built up in debt market. The markets have already rallied by around 20 odd basis. So I think incremental rally from here is limited. But from a fixed income market perspective, because no rate hikes are there is easy liquidity. We believe that investors should continue to hold on to their fixed income bets.
Do you still think there's a tactical opportunity of 20 to 25 bips even now, or that opportunity is gone?
So my understanding is, as I told you, that end of August, we had seen 10-year levels touching in around 660. The 30-year GSEC was closer to around 735-40 levels. Today, as we are talking, the 30-year GSEC has come down to 710. So from 735 to 710, 25 basis rally. And 10-year GSEC, the new 10-year is now trending around close to 640-42 levels. So around 22 basis lower. So there has been a 20 basis of rally in the last 30 to 40 odd days. I think if there are 2 rate cuts, and which we believe so, if there is a possibility that if tariff continues the way it is, RBI might deliver 2 rate cuts. If there is a second rate cut, I think probably we might see another 10-15 basis of rally. There are some additional good news for bond markets, I think, which we spoke last time, is that Bloomberg is seriously evaluating our bonds to get added into the global bond aggregator index. If that happens, we get another 20-25 billion of flows in India, which will take care of the demand supply imbalance. That might lead to some more of rally as per us. And then bond markets can see, the 10-year GSEC can see a level of around 630. So our view is that yes, tactical opportunities still persist, but they are very, very limited. And investors should now focus on the short end of the curve and look at more on the corporate bond segment at this point of time.
Okay, so that was my next question to you. How should investors look at investing across the entire curve, or which is the actually right opportunity or right spot for them?
So Shani, as we have highlighted, there are 3 sets of investors. One is who are looking at parking solutions. We continue to advise them money market solution. Why so? Because liquidity still remains very positive. Today also liquidity is around close to 4.5 lakh crores positive, and there are some 50 basis of CRR cuts which are still to come. If once that gets the liquidity comes into a system, liquidity is going to remain ample till March 2026. So our view is money market is a good solution for parking. The investors are looking at more broader medium-term solutions. We have always advised 2 categories. One is the income plus arbitrage at this point of time, which is a tax optimal efficient solution for investors who are looking at 2 year plus of investment horizon. The second category we need to look across at this point of time is corporate bonds. So I think these are the 2 categories investors should focus on. The third part is just very, very tactical investors who are looking at some immediate capital gains. I think they can focus on gilt funds. But as I told you, opportunities from here on are limited.
Okay. Thank you so much, Devang, for your valuable insights. And I really hope that you investors have a lot of takeaways from this conversation. Stay tuned into Moneynomics.
Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.